Welcome to the Winner's Playbook. Every winner needs a game plan, and this one's for you. Disclaimer: the information contained in this podcast is general in nature and does not take into account your personal situation. Please head to the show notes if you wish to book in a free 15-minute call to discuss your personal situation.
All right, guys, welcome back to the Winner's Playbook. Today, we're going to be talking about investing in a high-interest world, where to put your money in 2025. I don't have Billy at this point in time. He's away on leave, but I've actually got my old co-host, Steve Sloan. He's back in the hot chair this week. Steve, how's things been, mate, and what's the latest?
Great to be back. I've missed it. Back on the podcast. First one for 2025. Mate, look, you and I have been very busy on the growing the business front. We've done 3 acquisitions over the last 6 months and plenty more other businesses we're building. We're building an accounting business, a mortgage broking business, and the wealth business. So plenty going on, and busy on the family front too. So currently in Adelaide, but I've been travelling around the country a fair bit this year to get the lay of the land, and it's been a busy start to the year.
So, Steve, I'm aware that both of the kids took out the swimming carnival over the last couple of weeks. So, are those Sloan genetics in sports are playing dividends, or what?
I'd like to see. It's good to see they've got a bit of fight, mate. I've said this to you before, but I can't swim to save my life, so it's good to see they can. But yeah, it was good to see a bit of guts. And Harvey, 3 wins from 3 races yesterday, so I was super proud, Dad. It was good.
Yeah, that's great. They don't give out participation ribbons these days, or they get first,
like
second,
what
and
you
third?
and I used to get those. Is that what you're saying?
I thought these days sometimes the schools are a bit, about coming first and second, and everyone's kind of a winner. But it doesn't sound like that's the case over there.
No, they it's first, second, or third. If you don't get that, you don't get anything. Which is, look, I sort of like it, but it's teaches you a hard lesson in life.
I like that.
So I prefer this method. And look, fortunately enough, my kids were at the other end of the spectrum this time, so I'm happy with that. But often it doesn't work out that way. So.
No, well, a bit of adversity is not a bad thing. So I'm sure they'll experience that at some point in time in life. But yeah, like you said, Steve, we've got plenty going on at this point in time.
Yep.
With the acquisitions, property purchase, we'll talk a little bit about that because we have bought a property through the business, and that does relate to the topic we are talking today about. And we're also going to be down in Tasmania for our first annual conference down in Tasmania next month. We'll have all the Melbourne team heading down there, linking up with the Tassie team as well, and it's going to be a good trip in terms of talking about a lot of key items on the agenda in terms of where we're at now and what Link and related businesses actually look like in 10 years, which is going to be some pretty exciting stuff to get into. But if we dive into the topic, Steve, talking about interest rates, the effect on the market, where are we going to be putting the money at this point in time? Just in a nutshell, like higher interest rates, how's that generally impact investment philosophy, strategy? What are we thinking about at this point in time?
Well, higher interest rates means easy money in cash, right? So you don't have to think about it. You get a good return, good dividend on a bit of cash, and so people generally flock to the cash rates when they're good like that. As they come off though, and the yield comes off, and you're not earning what you want to earn on your cash, well then people start searching for alternatives, and that's clearly what's sort of happening now. People are like, okay, we might have hit the top of the market in terms of interest rate return. Where to from here? And as those interest rates come down, well, they start reducing what you get paid on your savings account, and that's probably clearly going to keep happening over the course of this year into next, I'd say. And so people are going to start searching for other assets, and those other assets are generally growth investments. So when defensive assets are going well, probably vice versa for growth investments like shares and property. And then the alternative is when cash accounts aren't paying too good on return, well, people are going to start searching for that yield, and that's generally in property or shares.
And that's what you're seeing during COVID as well, because there was a lot of retirees back then that couldn't put money in term deposits because they would get like 1 or 1.5%. So they were actually forced into the share market and some of these more growth type investments just to even get any sort of return on your money. But it is going to be interesting to see how that sort of plays out now, particularly if you look at like the bond market, because some of the returns in the bond market now that interest rates have gone up and bonds took a massive hit when the interest rate cycle really kicked off there, and there was some big capital losses coming through some of those bond funds and investments. But now that interest rates have sort of stabilized and slowly going to be on the way down, there's actually a bit of a play there that can happen around bonds where you can actually get a bit of a capital gain as those interest rates come down, and they're also then going to provide a good yield as well moving forward. So it does really talk to the fact that you definitely need to stay agile with your investments. And I think it's worthy of noting though, interest rates, there's no way they're going back to COVID times of 2% mortgages or anything like that. I think the markets at the moment are pricing in, if you look at the actual ASX rate tracker, it's pricing in at least 2 or 3 rate cuts over the 12 months. But we also note that sometimes it doesn't even play out like that. It could, maybe there might not be any more rate cuts for the rest of the year. It's really a bit of a watch and see. And I, for one, I don't really try and, like, I take notice of it, but I don't really make my plans around the expectations of what might happen there. I think you can only control what you can control, and you kind of got to just figure your way around the rest of it, because who knows what interest rates will do. Maybe they go up. Who knows? Even though all the expectations are as they're going down. It's look, 2 to 3 rate cuts not going to really move the dial a great deal, I think, even if it does come through. What are your thoughts there?
No, that's right. It won't make much of a difference, to be honest. What's the repayment difference on that? Not much, right? Like, it's, the cost of living has been smashed out of the park. This week Labor's come out with a tax cut of 1% that gives you $5, $5 in your pocket each week. Well, your grocery bill's gone up by $50. So what's $5 going to do? Really. Yeah. So all this stuff, as you just said, that's small change. You got to think bigger picture, bigger ticket items, because that smaller stuff's not really going to make any difference whatsoever to your budgets or what you got to spend. So you just got to get smarter, invest better, go bigger, and go harder. Because this small change stuff, 1 or 2 rate cuts or $5 back in your pocket that can buy half a coffee, not going to change your world.
No, and historically interest rates have been, kind of maybe a little bit lower than where we are now, but a mortgage interest rate of, say, 4 to 5.5% is pretty normal. So I guess we've got to be used to that, and not sort of live in the past of those COVID times that we're living in, where we had 2% interest rates. I actually seen a client the other day who actually locked in a five-year fixed term rate, or a fixed rate of under 2%. She's still on it. She's absolutely laughing. Wow. Yeah, still on it to, I think, 2027. So I think that's probably one of the best I've ever seen it at that. But those times definitely aren't going to be coming back anytime soon, or maybe ever again, unless there was a real economic shock. But what if we talk to stocks, property, those more growth type investments? Are they still worth it? How do you sort of invest in the higher interest rate environment, or even with the view of interest rates maybe coming off a little bit here? Does it really deviate our strategy a whole great deal in terms of how we approach?
Not at all, really. No. Like, it really doesn't. Like, long if you've got to take a long-term view on investing, bips in the radar about percentages, increases, whatever it may be, you want to buy good assets when you can. Yeah, it's that simple. If you can buy good property, good managed funds, good stocks, even, just buy it when you can afford to buy it, right? That's the idea. And buy good assets. It's about buying good assets and holding them for a long time. And if you do that multiple times and build up a great asset base, well, you've won the game. And so it's about getting just setting yourself up properly. Don't worry about that small stuff in between. If I can look at my own point of view, like, we're still out there buying property, and I look at this stuff all day. Like, you and I have just bought a commercial property. We're about to, and a big commercial property, big spend. And so we're tapping into that market as the company buys that office. I'll probably get back on the residential wagon again soon, and maybe buy another residential property. I know you've been buying a couple, and that doesn't change your view. And you and I sit there and look at this stuff every day. So absolutely not. They're definitely still worth buying and holding, but they've got to be good assets. You need to get the good ones, not the bad ones. So that's probably the key part of all that.
Yeah, and I think you can just be opportunistic in these times. Naturally, in certain markets, particularly if we talk about the property that we're just buying at the moment through the business, being an office space in Melbourne. Melbourne commercial prices have been hammered post-COVID. Like, we've been looking for a property in an office for a couple of years now, and some of the discounts that we come across in terms of these assets that had been purchased at a certain amount and had dropped 30%, 35%. From when they were purchased maybe only 4 or 5 years ago. So, if you are in the right position, you can take advantage of these opportunities and environments. But again, it's, trying to pick the bottom. You're never going to pick the bottom in the markets as well. And although we're probably maybe at the bottom in terms of commercial office space, who knows? But you maybe there's not a huge more amount of downside there. But really, in the end, even if you miss the bottom, you're investing long term anyway. So if you miss it, you're down a little bit shorter term. Ultimately, it is what it is. And I've done the same thing with residential property, and I've been going pretty hard there over the last couple of years. And with knowing one of them in particular has grown really well in just a 12-month period of time, like up over 20%, which is not a normal rate of return, but and that's with interest rates hadn't even been cut over that period of time. So I think it actually talks to the, when you talk about property and stocks, like particularly property is not just like one, it's an asset class, but then you look around Australia, there's all the different states doing any one thing at any one point in time. And Melbourne hasn't really done much over the last couple of years from a price perspective. But I know over where you are in Adelaide, Steve, like, prices have been going well for quite some time now. Queensland, where one of the properties I purchased, Perth has been really hot over the last 12 months. So it's it's really about that diversification and if you can take advantage of it, but don't forget that we are investing longer term and naturally as interest rates fall off, well, that can then help a little bit on your investment journey in terms of your repayments, if we're just talking from a property perspective.
Yeah, totally. And like, mate, as the economy changes and moving with the times, how do people adjust their strategies over that period? Like, what's some of the key takeaways you can do as things change and move forward? What are the major things you should be looking at?
I think it's really where you're holding your excess cash for one. So, if you've got a mortgage, maybe the offset might be a better place to put it than a savings account generally. It depends upon what your interest rate is, but usually interest rate still is going to be around about at least 6%, maybe a little bit more. And if you're looking at the best paying high interest saver at this point in time, I think ING still gives you 5.4%, which I was actually surprised to see when I just had a look at it. I thought they might have pulled that back a little bit, but I believe they've still got 5.4% on the 100 grand that goes into the ING saver. And talking to savings accounts, there's a couple of other good ones out there as well that we use for clients, but you got to be very careful because some of those do have these introductory rates and they can kind of trick you in a little bit of a way that you get it for 3 or 4 months and that bonus rate then comes off, or the introductory rate comes off a little bit. So I think you just got to be really conscious of where your excess cash is sitting. And if you've got a mortgage, it might be better to be sitting in the mortgage, because if your interest rate is 6% and you can only get at best 5.4% in a high interest saver, and that's still taxed your interest on the savings account as well. So if you get 5.4%, you're in the highest tax bracket, you're virtually getting a return half of that, which is not a great deal. Whereas if your money's in your offset or in your redraw as a secondary option, you're saving interest there equivalent to your interest rate, which is, say, you're getting a return of over 6% on your money. So that's not a bad option at all. So I think you just got to be very conscious of where your surplus cash flow is going as the environment does change. And then it's really, with all of my clients, like, we haven't changed the investment strategy. Like, all of my clients who are in accumulation have just been investing throughout this whole period of time. Financial markets have had great returns for the last 2 years, and that's even with these higher interest rate environment that we've been in. So, really, the strategy doesn't really change. If you're sitting on piles of cash, you can probably be a little bit more opportunistic around some of this and looking at certain markets or asset classes that have maybe been hit a little harder by higher interest rates. But all in all, it doesn't really change. And now that we are at the peak and we're coming off, I guess there is a bit more comfort around getting into certain asset classes like property, where there is a correlation to interest rates. And the last thing you want to do is be forced to sell a property as well. So you want to get comfort, I suppose, around that. But all in all, Steve, it doesn't really change. I don't know about you and conversations you're having with clients.
No, it's only when the only thing that changes is people need to create more income as they move off sort of work arrangements, or to change work, go part-time, or want to retire, things like that. That's really the time it really adjusts, right? Because you need to then have income coming in to pay bills and whatever and live. But no, I agree, stay the course, keep invested, stay invested. It's clear that that's paid off over time, and look at history. It pays off over time to stay invested. So nothing really adjusts there in my view at all.
And in terms of closing, Steve, like, using debt to your advantage when interest rates are higher, than where they've been in the past, like clients and debt, how do you approach that?
Debt's good as long as you do it right. It's you scale up your asset base where you can, take on good debt, buy more assets, as long as they're good assets, nothing wrong with that. But affordability, make sure it's affordable, of course, that's 101. But absolutely, taking on debt, as you say, use other people's money to do it. There's nothing wrong with that, and it's a great way to just build wealth. And if you do that over and over and over and over and manage that cash flow, then it'll pay off.
Yeah, it's using debt, obviously, for the right assets, good debt versus bad debt. So, good debt, typically investments you're looking at, maybe taking some equity out to invest in shares, or you manage portfolios or ETFs, or taking some equity out to buy an investment property, or it could even be going into businesses. I speak with a lot of different business owners in different sort of sectors through my exposure through the Entrepreneurs Organisation, or EO, and there's anything you can think of, there's a business for it. There's an opportunity there. And I seen someone the other day talking about, I didn't even realize there's the website Seek Business. So how you got Seek for finding a job. there's Seek Business, and I was having a look at on that the other week on a Friday night, just having a scroll, and there's virtually whatever you want. So if you really game, if you want to get your highest rate of return, I'd say maybe consider some sort of a business at some point in time in future. It doesn't have to be big, but that's really where you can start unlocking, your earnings potential and taking that to wherever you want. And then you complement that with your property, your shares, your ETFs, your managed funds, some cash there sitting on the sidelines as well. And it really doesn't need to be much more complicated than that.
Agreed.
No?
Just my advice is get stuck into it and have a crack.
Have a crack. That's a good way to finish, Steve, I reckon. Have a crack. I like that. It's good final words. But we'll close it out there today, guys, and appreciate everyone that does listen in. And if you're getting value out of the podcast, 5 stars on Spotify and Apple. If there are any particular topics that you do want us to speak about, just feel free to reach out and engage with us directly and send us a message. You can track us down kind of on any social media platform whatsoever. Check us out on all of the socials. We do have a weekly newsletter that goes out that you can subscribe to that gets sent out via Steve. And of course, if you do want to chat about your personal situation with any of the financial advisors in the business, or even chat to any of the mortgage brokers or the accounting team in our business as well, you can jump on the website and basically take your pick. But until next time, Steve, I'll see you then, mate.
See you then, mate. Cheers. Bye.